Namaste everyone and welcome back to the lecture 9 of Fundamental Analysis of Companies. In the previous lectures, we have done the profit and loss statement, the balance sheet, the cash flow, and finally we have completed our financial ratios. It took us 4 lectures to complete the financial ratios. So now you might be wondering that you have learned so much, but how are you gonna get meaningful insights, or how are you gonna take action items on what you have learned? So we have always talked about two things. The first is to understand the physical significance, and the second is to take the action on what you have learned. So this lecture will be focusing on stitching whatever we have learned till now into a single sheet so that you can come up with a score, and based on the score you can get a meaningful insight on how the company is fundamentally doing. And after completing this lecture, we will be going over to the remaining of the points. So let's start our lecture. With so many criteria and so many parameters, it becomes so much difficult, right? And you can't really apply whatever you have learned till now. All the parameters you cannot apply to analyze all the companies because it is going to take so much of your time. And that's why we have started this lecture, to understand and to filter out the companies in an easier way. So the strategy which we are following here would be your knockout and elimination strategy. So for the knockout, we have decided 4 of the parameters, and the parameters are your Piotrowski's score, your block deals, your Graham's number, and your PEG ratio. Now you are already aware of your PEG ratio, right? Yes, we have covered this in the financial ratio lecture 5. Now let's try to understand the remaining of the 3 parameters. The first is your Piotrowski's score. So Piotrowski's score is from 0 to 9, and it gives the fundamental of how good a company is. So 0 being the company is fundamentally weak, while 9 being the company is fundamentally strong. Now you might be wondering, why are you learning so much? Why can't you just look at Piotrowski's score and say whether the company is fundamentally good or not? You can do that, but it's very important to understand what is going in the background of the Piotrowski's score. Okay. Now that is something which we are going to cover in our upcoming lectures. For now, just focus that Piotrowski's score gives you an overall bird eye view of how good the company's fundamental health is. But you really have to dig deep in to understand whether the company's health is really that good or not, based on several criteria which we are going to see. The second is your block deals. Now block deals is something which happens in blocks. With what blocks means is that it happens in large quantities, and something which happens over a particular, suppose a share is sold above a particular quantity, then it has to be notified to the SEBI, and SEBI has to put this information in public. Now there could be two things. One is block deal and the other could be your insider trading. Both of these have to be notified to the SEBI. This is our second parameter. The third parameter is our Graham's number. Now if you have read the book The Intelligent Investor by Benjamin Graham, you might already know this, and if you don't, it's a very simple number which tells you whether the company is undervalued or overvalued. Okay, so let's go and understand the Piotrowski's scores and the Graham's number in detail in the next slide. Now your Piotrowski's score works on 9 parameters, and if the parameter is good, we rate it as 1, and if the parameter is bad, we rate it as 0. And the parameters are your net income, your return on assets, your net operating cash flow, your operating cash flow versus net income, your leverage, current ratio, outstanding shares, gross margin, and asset turnover ratio. Now you don't have to worry, you don't have to really analyze all these separately. You can just take the Piotrowski's score, which is directly available for free, and just use it. But this table is just for reference. If you really want to dig deep, you can pause and look through it. These are the same concepts which we have already covered. They have just used these concepts to generate a score, okay, and use that score to find whether the company is doing fundamentally good or not. And this score, as you can see, basically works on the historical part. It basically compares your current year's financial with the last year to judge it. So that's all for the Piotrowski's score. And I've given the link in the description for the original paper written by Piotrowski if you want to go further deep in. So next, let's discuss the Graham's number. If you remember in the lecture 2, we have discussed a bird's eye view of the overall health of a company, where we have discussed this number. So Graham's number is the square root of 22.5 into earning per share into book value per share. Now this 22.5 has been developed by Benjamin Graham in his book The Intelligent Investor, and it has been widely followed. So this number basically gives you whether the company is undervalued in terms of its stock price or not. Okay, and so basically if your current market price is less than your Graham's number, we call this as an undervalued stock. But there is no distinct line in it. Suppose your Graham's number is 1000 and your current market price is 1050. Still, you can call that as an undervalued. You really don't discard that company calling it overvalued because it is costly by 50 INR. So this margin you can decide by your own. And that's all for the Graham's number. So finally, the moment is here where you are going to apply whatever you have learned till now and try to understand the fundamentals of the companies. So the first column which we are going to see here is whether it is posing you a question whether your knockout criteria is fulfilled or not. Similarly, you will have multiple questions for health score, valuation score, debt score, margin score, return score, so that you can know what are you trying to do in these particular rows. Then you have the second column, which is your parameters, where we will have multiple parameters. For the knockout criteria, we have these 4 parameters. Then you will have your physical significance. Now, there would be a lot of scenarios where you will forget what the physical significance was. And then I don't really want you to go back to the video and waste your time finding through the timeline where that particular concept has been explained. So we have written it nicely here so that you can understand it quickly without wasting your time. Then we will have 2 columns to compare. On based on these columns, you are going to rate your parameters. So this is your peer comparison and your historical comparison. Now some of the parameters would require you to have a peer comparison, some historical comparison, and some both. Now when you will find that a parameter requires both peer and historical comparison, the net output would be the multiplication or the AND gate for that particular criteria. And then you will have your score. This is your total score out of. And then you will have your quantify. We really want you to quantify the number so that after you have analyzed the company fully, you can go back and have a bit detailed analysis in it and have a better understanding. And then you have some comments if you want to write down something like some of the parameter is good but there is a red flag, you can write it here. So let's start without wasting any time. So let's start to find the Piotrowski's score, the Graham's number, and the peg score and the peg ratio. So for doing this, let's go to our screener.n. Now in the screener.n, this time we are changing our example. We are not taking Tata Chemicals anymore. We want you to have a wider grasp and not just stick to Tata Chemicals. You might be bored with using the same example. So let's go to Greaves-Good. Okay, now Greaves-Good is a company which engages in manufacturing engine applications, trading power mills, spares related to engines, electric vehicles, etc. Let's go down to the peer comparison table and you can click on edit columns to get the column of Piotrowski's score, Graham's number, peg ratio. So these are some random columns, you can delete them if you want. So the Piotrowski's score from Greaves-Good is 6. Okay, it's greater than 4. The Graham's number is 72 while your current market price is 135. So you can see that your current market price is way higher than your Graham's number. So definitely the stock is overvalued. Then you have your PEG ratio as minus 3.33. Now PEG ratio should be less than 1 but not less than 0. And if you really wanted to find out the growth rate, what you can do is you can really divide your PE ratio by your PEG ratio. So if you remember, PEG ratio is PE ratio divided by growth rate. So you can find growth rate by dividing the PE ratio by the PEG ratio. So if you divide 40 by minus 3.33, you would get something like minus 12% of growth rate. Okay, so let's go to our sheet and try to fill in these values. So your Piotrowski's score is greater than 0, greater than 4, sorry. Yes, it is. So its score is 1. The third is your Graham's number. Is it less than is your current market price less than Graham's number? No, so this goes to 0. And your PEG ratio, is it greater than 0 and less than 1? No, so this goes to 0. Now you have to quantify it also. So your growth is somewhere around minus 12%, which is not really good, but this is a projected growth. It can change. So you really can't rely a lot on this, but this still gives you a bigger picture. Okay, now Graham's number is somewhere around 72, while your current market price was somewhere around 135, and your Piotrowski's score is 6. So you can quantify it so that you can look at it again and you really don't have to go back. Now let's go to our block deals. Now today I am also introducing to you to one of the new sites, and the name of the site is trendyline.com. So this is our trendyline.com. You just have to type trendyline.com and it will be here. And this is not a gimmick website. They have a lot of customers. Like even Money Control itself is a customer of Trendyline, IIFL, Edelweiss, ICICI Direct. So when you see data from these websites, they are sourcing their data from trendyline.com. They could be partial or the whole data, but Money Control Pro even uses Trendyline data in the Money Control Pro, and it even labels there that the data is from Trendyline. So this site is like pretty trustworthy. Now let's go to Grief Scoot, and it's basically called Grief's Cotton. The share name is Grief Scoot. And scroll down, you don't really look at all the numbers and get confused, but feel free to explore it. So if I go to these deals, insider, bulk, block, and SAST. SAST is basically your deals from your takeovers and whatnot. So you can see the first column here is bulk and block deals, and you can see the last block deal happened in 2022. So we can just ignore this. We want a recent quarter deal, something recent. So here is something interesting. You see that the director and KMP is your key managerial person have disposed of the shares on 23rd June and 6th of July at a price of 140 and 135, while the promoter have actually acquired the shares on 15 June. Now you might be confused. So as you know, if the key managerial person and the director are disposing of the shares, it's a bad thing. I mean, it's a very bad thing actually. Unless and until there is some requirement to the director and he just want to sell off his share to raise money for his personal or professional reasons. But that is not really always sure. So whenever a director or key managerial person sells their share, it's considered as a bad thing. Okay. Now you might be confused that promoter has been buying on 15 June, but they are selling on, but the key managerial person and director is selling on 6th July and 23rd of June. Still, the recent data says that the director and KMP have disposed of a good amount of shares. So we are going to consider this as bad news, actually a pretty bad news. So let's go to our sheet, our strategy sheet, and this is pretty bad. So it's 0, and just ignore this if we cannot quantify this. We are not going to quantify this. You can quantify if you want. So we can here write down that director and key managerial persons have disposed shares, okay, recently. So now your knockout score is 1. You can just add all of them. So out of 4, you have only 1 score. And if you know, if your all this was 0, then you really don't have to proceed further. That's it. You are going to knock out this table from your list, because this company would look pretty unhealthy in terms of fundamental. Okay, so you can just knock it off if this score was 0. So it is, since it is 1, we still want to proceed further to look how is the company doing. So let's go to the second part, which is your health score. And I mean, don't get confused with all these labelings. You have already learned them. So if you remember from the lecture 2, we have started learning the sales, the operating profit, interest. And in the lecture 3, in the balance sheet, we have learned your reserves and surplus. And in the lecture 4, we have learned your cash flow and free cash flow. So whatever we have learned, we are just stitching it. There's nothing new what we are saying here. It's just we are teaching you how to score it. And you have the right to change your scoring parameter based on your risk appetite. But this is good for a starting value investor. So yeah. And you might be wondering, where is the knockout row? So we have just hidden it, so you can hide and unhide it. Just so I'm just going to hide this for now. Okay. Now you can see the first parameter in the health score would be your sales. So sales is your money received from selling products, and it will be your historical comparison that your sales in the last 5 years is increasing, and it should be greater than your inflation percentage. So let's go to our screener.in and let's go here to Grief's Cotton, and let's go here to your profit and loss statement, and you can see the sales from last 5 years. It is March 2029. So it was 2015, while in March 2023 it was 2699. So your sale is increasing, but how much percentage is it increasing? And if you really wanted to find out how much percentage annually it is increasing, we are going to use the same formula which we have used in the CAGR. So I can write the formula here for you. So the sale is your final value, which is your 2699, divided by your initial value, and your initial value was 2015. and to the power of, we are taking a data of 1 by 5 years, so it is 0.2. Okay, this is your 5-year CAGR and this minus 1. So this is the formula: final value by initial value to the power of 1 by n years minus 1. So this will give you a 6%, and inflation is also almost 6%. So we will say it's just beating it, or we can say the sales has hardly increased. So we will rate this as 0. Okay, now let's go to our second parameter, which is your operating profit. Now your operating profit is your earnings excluding depreciation, amortization, interest, and taxes. Please feel free to go to lecture 2 to learn these terminologies if you are not sure of them. Now it should be positive. The first thing, operating profit has to be positive. Okay. And then it has to be increasing over the last 5 years. So we are going to multiply both of their score. And if any one of this is 0, the net score will be 0. Okay. So let's go to our screener.in again, and the operating profit from March 2023 has been 127 CR. So it is positive. Okay. Now, is it increasing from last 5 years? So we can see in March 2019, it was actually higher, and then it has decreased, and then again it has increased. So it's like a U, but even this increase is less than what they have made in March 2019. So we are gonna say that it has not increased, so this value again becomes 0. The third is your interest. Now interest is something which you have to pay back. Okay, now the interest should ideally be decreasing over 5 years, or it should actually be remain same. Any one of this is fulfilled, we will label it as 1. So you can see here it is OR. Okay, if it is AND, then you have to look at both. So let's see how is the interest doing. So the interest from 2019 was 4 crores and it has increased to 12 crores. So this is not a good sign. I mean, we have already discussed that companies do take loans to expand their business. So loan is not bad, and if you take the loan, you will rise the interest. But these are the parameters, right? So if they're increasing the interest and they are able to expand it, then somewhere in the future or in the current year, they should show a potential growth in profit or operating profit. But if it's not showing and their interest is rising for this financial year, we will say that this is a bad thing. So we are going to label it as 0. And the overall score will tell us how good it is. So not just the interest. Then you have your reserves and surplus. And you know what reserves and surplus are. So if not, please feel free to go to lecture 2. And this should increase over your last 5 years. So let's go back, and you have to go to your balance sheet. Now this balance sheet has been actually covered in lecture 3, not 2. So you can go to reserves and surplus in lecture 3. Now you can see the reserves and surplus for March 2019 was 920 crores, and for March 2023 is 1540 crores. Okay, so it has increased. It's a good sign. So let's put it as 1. And if you want to quantify it, you can again use the same formula. So I'm just going to copy it from here to here. Okay. Oh, okay, here I've used the values. So let's change the values. So it is from your reserves is 1540 and 920. Okay, so 1540 in current financial year and 920 in year 2019. So this is a 11% increase. Okay, not bad. The next is your operating cash flow. Now from here we have started with our lecture 4. So operating cash flow should be positive and should have been increasing over last 5 years. So again, let's go to screener.in, and you can see that the operating cash flow in March 2019 was 145 crores, while in March 2023 it is negative. So operating cash flow is negative. That means they are not able to generate money from their operating activities, and that is a very bad sign. Let's call it 0. Now the last is your free cash flow. If you remember, your free cash flow is your operating cash flow minus your capital expenditure, right? And the criteria is that your free cash flow should be greater than your current liabilities. So let's go to screener.in, and you can see that, so you can directly see the free cash flow, or if you want to calculate it, you can take from operating activities, which is minus 135 crores, and the capex, your capital expenditure, is your fixed assets purchase, so minus 79 crores, and you have also sold some of your fixed assets, so plus 8 crores. So this will be totaling giving you a 206 crore, or you don't have to calculate it. As you know, we are not going to calculate anything. So let's go here on the top on the peer comparison table. You can get this column by clicking here and editing it. So the free cash flow for Greaves Cotton is in negative, and I mean, if it's negative, you don't really have to check whether it is greater than current liabilities or not. Having a negative free cash flow is a bad sign. Okay, let's call it 0. So your total score here again is 1. So your health score of a company is 1 out of 6. Okay, you can here mention that it is minus 206 crores. Okay, let's enter CR at the end. So there's one thing you have to be aware, that we are here using the percentage. So by default, if I go here, my column is selected as percentage. And if your column is not selected percentage, you can click here to make it into percentage or multiply by 100, but make sure this is in percentage. I mean, this value should be 0.06, and don't call it as 0.06%. I mean, I know most of you would be aware of it, but just to notify. Yeah. So let's hide our health score and let's proceed to the next part, which is your valuation score. Okay, so let's go here and hide this. So the valuation score, the question is the company undervalued? Okay, we are going to find out if your company is undervalued. By undervalued, it means is the current stock price way less than what it should be, and that is where the opportunity of growth as an investor is, not for the company but for the investor, that the share price can rise if the company is good and undervalued. Okay, now these are the 4 parameters we are going to see. And the PB ratio is premium willing to pay over the book value. Your EPS is how much money your share is earning. Your PE ratio is price willing to pay in order to earn 1 rupee. And your PEG ratio is price willing to pay in order to earn 1 rupee at a 1% growth rate, annual growth rate, 1% annual growth rate. And these are the criteria which we are going to follow. Okay, so let's go to our screener.n. So this is your screener.n, and I've already typed Greaves Cotton here. So you can see that the PB ratio is 1.98, and the criteria was ideally it should be less than 2 or at least less than the industrial median, and the industrial median is 5. Now you want to find out how many companies are taken into account while finding the industrial median. So it is only 4 companies. Okay, so you can so that means that your price to book value is pretty good. It's undervalued. So let's put here 1. Okay, and we can put a score here of 1.98. The second is your EPS, your earning per share, and the criteria is that your earning per share divided by your current market price, CMP is current market price, should be greater than your bank FD, and your EPS should also be increasing over the last 5 years. So let's go and check it out. So your EPS is actually only 3, and if you divide 3 by 135, you are for sure not getting it greater than 6% of the bank FD rate. So it will be only around 2.5%. Now, since your first criteria is failed, we are not going to look whether your EPS is increasing for last 5 years or not and label it as 0. But for the sake of, let's first put it here as 2.5%, for the sake of knowing how to see whether your EPS is increasing over the last 5 years or not. So this is a historical comparison, and for historical comparison, we are going to use your moneycontrol.n. So let's type here Greaves Cotton. And let's go down to your financials. Yeah, here. So you want to find out how your EPS is doing. So even in the overview, you can find the EPS. So you can see your EPS has decreased even to negative values, and this year it has risen. But overall, I would say in the last 5 years, the EPS has not increased, right? So it is again 0. So this value goes as 0. So now the next is your PE ratio. Now for the criteria for PE ratio is that the PE ratio should be less than 1.5 times of industrial median. And this condition is true only if your industrial median is less than 4. Because we have seen if the industrial median is very low, it's say 2, 3 or 1, then really just putting it less than industrial median would be a bias. So we are saying that it should be 1.5 times of industrial median when it is less than 4. Otherwise, the criteria is that the PE ratio should be less than industrial median. Okay, so let's go and find out what was the PE ratio. The PE ratio here is 40, and it is way above than your industrial median. So this is an overvalued company in terms of the price you are willing to pay to earn 1 rupees. Okay, so let's go and put here 0. The PE ratio is 40, you can put it. And now last is your PEG ratio. We have already analyzed this in the knockout criteria, but let's look at it again. So it is negative. Okay, so again, this is your 0. So your valuation score is 1. Okay, now this is basically telling you that is your company undervalued with one score out of four, and accounting for the growth rate. I would say that the company is not really undervalued. This score should be at least three or four to really call a company undervalued. I mean, even if the growth rate is maybe not very good, at least these three conditions should be pretty strong for you to say that the company is undervalued and a value stock and you should go for it. Okay, so yeah, that's it for the valuation score. So let's hide the valuation score. Now, after looking at the company's health score, valuation score, next question we have to ask is, can company pay its debt? Does company has enough resources or cash in hand to pay off its debt? Okay, so for that, and that has been explained in lecture 6 if you want to understand these ratios in detail. So the parameters are your current ratio, quick ratio, debt to equity ratio, and interest coverage ratio. To revise, your current ratio is if your company can pay its current liabilities. Quick ratio is if you subtract your inventories from your current assets. And in that case, can your company pay your current liabilities? Now, debt to equity tells you that how much of your business is financed by debt and how much is financed by its own funds, which is equity. And the interest coverage ratio would basically tell you, does your company has enough money to at least pay off the interest from the loans it has taken? Okay. Now, for the current ratio, the criteria is that it should be greater than 2, or it should be greater than the industrial median plus minus 0.5. The reason we have added plus minus 0.5 is because industrial ratios, the current ratios generally are around 2, 3, 4. And if the industrial median is somewhere nearby, making it too tight to just have to be saying it to be greater than industrial median would actually be quite tight criteria. So we have added a margin of plus minus 5. And the second thing is that it should be increasing over the last 5 years. So let's go to screener.in, and I've typed here Greaves Cotton, and I've changed these columns. So every time you will see these changed because I've just changed it from here. So your current ratio is 2.3, while your industrial median is 2.12. So yes, it is greater than industrial median and within the range of plus minus 0.5. Okay, so that means it's a good thing. So let's put this as 1, and let's put this as 2.3. The second is your quick ratio. So your quick ratio, the second thing we have to look is whether it is increasing over the last 5 years. So let's go to moneycontrol.in, and let's go here to your ratios. And you can see here you have your liquidity ratios, and you can see the current ratio has been increasing. So that's a good sign. So this value will be 1. Okay, because this was 1, and this is 1. The second is your quick ratio. So let's go to screener.in, and you can see that your quick ratio is 1.99, while the industrial median was 1.78. Again, the quick ratio looks good. And so let's just put this as 1. The third is your debt to equity ratio. So your debt to equity ratio should be ideally less than 2 or less than your industrial median plus minus 0.5. And the second criteria is that your debt to equity ratio should be decreasing over the last 5 years. So let's look at the first criteria. Your debt to equity ratio is pretty low. And later you will find out that this company is almost debt free. I think this is one of the great advantage this company has. So if I go for the last 5 years, and if I go here to my leverage ratios, you can see my debt to equity ratio is almost 0. So it's almost reduced. Okay, so let's just put this as 1. And the last is my interest coverage ratio. So let's go to screener.in, and you can see that my interest coverage ratio here is 11.72, while the industrial median is 54. But as you know, I mean, you won't say that this is bad, because as you know, the company is debt free. So this is a special condition, and if there is no debt, then you really don't have to look at this ratio, right? So you would still make it at 1 and call here it as debt free. And this is actually a very big thing we call. If a company is debt free, that company is assumed to be pretty good in terms that they don't have to pay the interest or the debt, so they can manage their funds pretty well. So you can see the debt score here is 4. So for Greaves Cotton, although the health score and valuation score was not pretty good, but this point is pretty good that they can pay off their debt pretty easily. Now, the next thing which you have to look is if your company is improving margin over its product, whether your company is improving its profit margin or at least maintaining the same margin. It should not happen that your company's margin is reducing. That would really affect its profit and the whole business. Okay. So you can find these ratios in the lecture 7, and we are going to discuss the gross profit, the operating profit, and the net profit. Now, just to revise, the gross profit is the margin. The gross profit margin is the margin which you make just on making the product, including the direct cost. The operating profit margin is when you include your operating cost into account, and your net profit margin is when you include your interest and taxes also into the account. So here, this is our criteria that these should be greater than industrial median, and these should increase or at least remain same over the last 5 years. Okay, so let's go to screener.in, and I've labeled it here. So your gross profit margin, this is for quarter. And as notified before, the screener.in doesn't has this for the year. So it's okay to use it for a quarter too, because we are comparing all the peers even for the quarter. So the gross profit margin for the quarter is, actually it's less than industrial median. So this is a bad sign. No, not really a bad sign. It's still 25%, but for our criteria, I mean, we have fixed something and we are going to follow that discipline. So we will label it as 0. For operating profit margin, you can see the drop. That basically means their operating cost is not really optimized, or maybe the industry is not good enough to optimize the operating cost. But that statement would be wrong because the peers have a better operating profit margin. So this is also 0. And the third is your net profit margin, which is just 3%. And this is even way less than your industrial median. And so this also goes to 0. But just for the sake of analyzing the last 5 years data, you can go to moneycontrol.com and you can go to the margin ratios. You can see that the gross profit margin has actually been reduced. The same is operating profit margin, the same is net profit margin. Now, this is not a good thing. This basically means that somewhere the company is not able to make the profit which it was making before. Okay, so this goes to 0. And this whole score goes to 0. So you can infer from this that the company's margin score is not good. So let's hide this and go to our next ratio, go to our next score. Now the next question which we are going to ask is, how much return can I expect? Now this is the return which a shareholder gets, okay, based on the CAGR and net returns, and your ROCE is the return which your company can get on the capital employed. Okay, so just to revise the concepts, if you really want to go in deep, just go to the lecture 7. It's hyperlinked, you can just click here. So ROCE is the return on the capital employed. It means if I put 100 rupees, how much money can I make it? CAGR is this time CAGR, we are calling out how much your share price is increasing every year. Okay, so this CAGR is compound annual growth rate for your share price increase, and this counts into your return. And your net return will be your return due to your dividends and your return due to your CAGR. Okay, so the criteria is that your ROCE should be greater than industrial median, and it should have, now this is and, okay, both condition has to be fulfilled, and the interest from your FD, and your ROCE should be increasing over your last 5 years. For CAGR, it should be much greater than your bank FD. When I say much greater, it should be at least 1.5 or 2 times of your bank FD. Otherwise, there is no point in taking a lot of risk and getting just 8% return or 9% return, while you can easily get a 7.75 in some of the FDs. Then your net returns really depends on you. Is it meeting your expectations? Somewhere around 10, 12, 13% is pretty good enough. And if you have expectation of 15%, you can go into much more detailed analysis. You have to be more aware and you can still make it. Yeah. So let's go to screener.in and analyze these. See here, grapes, cotton. So you can see the ROCE is 10% while your median is 20.7. And our criteria was that ROCE should be greater than industrial median and bank interest FD rate. So the first criteria failed. So we are going to label it as 0. You can also see for last 5 years. For last 5 years, you can go to moneycontrol.com and you can just go to your financial ratios and here go to ratio. So you will find it here, ROCE. So you can see the ROCE is dropping. I mean, it was 25% and it is dropping a lot. So this is a bad sign. So we are going to label this as 0. The second is your CAGR. So CAGR, as you know, here in screener.in, it will be labeled as 1 year return and 5 year return. Now this return is every year. I mean, for the next 5 years, this is the yearly CAGR, compound annual growth rate return. Okay, this is not for whole of the 5 years. So you can see that for 1 year, the return is minus 13%, while for 5 year, it is minus 1%. That means if you would have invested money 5 years back, your share price would have been almost same. So that's a bad sign. And so yeah, let's first go and label this as 0. So this is not good. Now the next is a net return. So in the net return, we are going to count the CAGR and your dividend yield. Now dividend yield is your dividend divided by your current market price into 100, which basically tells you how much percentage return are you getting from dividend. So if you go here, you can see the dividend yield is even 0.15%. So it is also pretty less. I mean, if you add your dividend yield with the net return, it is still way less than the bank FD. So this basically means that in the last 5 years, it would have been very much beneficial to invest your money in the bank FD rather than in the Greaves Cotton. This is what it really means. But this doesn't gives you the future outlook of the picture, but definitely this gives you the history. Okay. So the return score is 0. So let's hide all these 3 columns. Now these are the last 3 questions we are going to ask. The first is, how fast are they selling? That means, are they able to have the same inventory turnover which they used to have? The second is the assets being utilized properly? And the third is, at a 0% increase in the share price, earnings and growth, in how many years would I get my money, would I get my investment back? So in order to answer these, we would have these 3 parameters, and you can go into deep in the lecture 8. Okay, so to revise them, inventory turnover ratio is in how many times is your inventory being sold. Asset turnover ratio is how effectively are you utilizing your assets, and EV by EBITDA is in how many years would I get my investment back, keeping earnings, share price, debt and cash equivalents constant. Okay, and these are the criterias. So let's go to screener.n. Here you can see that your inventory turnover ratio for Greaves Cotton is 9.65, which is higher than your industrial median. It's good. Even if you compare across peers, it's still higher. And your asset turnover ratio is also 1.24, which is as compared to its peers, and it is higher than industrial median. So let's go and fill here your 1 score. Okay. Now the last is your EV by EBITDA. We'll be discussing this more in the valuation models in the upcoming lectures. But yeah, this is in how many years would you get at 0% increments in a lot of parameters like growth and share price. So it will take 13 years for your investment. And the criteria here is it should be less than 10 or industrial median, and it is almost equal to industrial median. Okay, so we would still label it as 1. I mean, you can see that it's almost equal to industrial median. That's 0.5 times higher. And you can see the geoengineering has actually lesser EV by EBITDA. That means enterprise values has been valued lower. So that is a good sign for a investor to buy. That means the company is discounted. So we'll still label it as 1 since it is almost near to the industrial median. Now these dilemmas you are going to face when you are going to analyze and use the sheet, but it's okay. Use your common sense and go with it. So this is all for all these 3 parameters. So this represents your overall net score. So out of 27, your Greaves Cotton is getting around 10. Now, is it good or is it bad? This is the next question, right? This is the last question. Now let's look from top to bottom. Let's hide these. That's the whole reason that we are hiding it, because if we unhide all the rows, it would be you really might panic seeing so many parameters. But by breaking them into different scores, it's so easy, right? You can do the same. You can just hide them and unhide them. It's very easier. Now you can see the knockout score was 1 out of 4. That means the company's fundamental was not very clear. The health score is 1 out of 6. That means the company's health is not very good. Now, if you want to go back and see what went wrong in the company's health, you can just unhide it and you will find out that its sales is really not beating the inflation. Its operating profit is not increasing over the last 5 years. Its interests are not decreasing. So this is how you're going to analyze. So because when you are discarding a company from your portfolio or from your basket, when you analyze in detail, you should have these answers, right? So let's hide them again. The third is your valuation score. So is the company undervalued? Not really. I mean, the company's valuation score is 1. If it is 3 out of 4 or 4 out of 4, then it is considered undervalued. But one good thing is the company's debt score is pretty high. That means company will not default, or company will not default on its interest or go bankrupt this easily. The margin scores are zero. That means company is not able to increase its gross margin, operating margin, or net margin, and we have seen it is actually reducing it. Now the return score is also zero. That means if you would have invested in this company in the past, your returns would be poor. So your overall score is 10. Now, as you know, in this lecture or in this whole series, we are not suggesting you any of the stocks, whether you have to buy it or not. What we are teaching you here is whether you can, how you can analyze these stocks. So on analysis, you can see that the fundamental score for Greaves Cotton doesn't turns out to be that good. Now your question would be, what score is good and what is bad? So let's understand this in the next slide. Now these are your judging criteria. If your fundamental score is less than or equal to 10, we generally don't prefer. We call those companies as not very fundamentally strong. And if you look from between 10 to 15, we call them as look further companies, which basically means you have to look further into the economics and the industrial growth. If the industry is going to do good, then you can go with those companies. But if the industries are going into recession for those particular companies, we really don't prefer to invest in those companies right now. If the score is between 15 to 20, those are with good fundamentals. You can analyze further and go with them. And if your score is greater than 20, those are your companies with excellent fundamentals. But still, you have to look for your economics and your industrial growth. But still, if you invest in the companies which have a greater than 20 fundamental score, then basically you are on a safer edge. Even in the future, you might not be losing it. But remember, this method is something you have to do every year, or at least twice a year, or if possible every quarter for your portfolio. Okay, so that's all for lecture 9, and you might have seen that in this lecture we have tried to stitch all the previous learnings together and given you an action point on how to act. Now if you're new to investment, you can pick some companies and create a sheet like this, keep it with you. And if you are already invested, you can take your portfolio. By portfolio, I mean you can take the stocks which you have and put them into these scores and see how good they are. Now you really don't have to panic and sell or buy based on these scores. Please remember, this course is not for recommending you any stocks. These are all the random examples which we have taken based on which fits our examples. And based on the lecture, you can just find out whether the company is good fundamentally or not. A good fundamental company is worth taking the risk, always remember. But there are other market criteria, like there are news or there are sudden technological breakthrough which will set aside these fundamental scores. Okay, so this is something we are going to study in the future lectures. But please remember the two key takeaways: to analyze your portfolio at least quarterly or bi-yearly. Okay, and the second is to keep grasping the fundamental knowledge and analyzing how good your company is doing, and if any of the ratios are changing and the reason why they are changing. Because if you really want to invest a large chunk of money, you can't just invest it and get away for 30 years. That might work, but you will see a lot of companies which 30 years back were very hype, or even blue chip companies are almost worth zero or bankrupt after 30 years. So the ideal way is to keep monitoring them, and that's how you develop your portfolio or you develop your investment. You can't just put it and just stay away. So thank you everyone for joining the lecture 9. Hope you have learned something. Feel free to give your suggestions in the above given email ID or in the comment section. Thank you.